Hello everyone, welcome to Just Invest Today. And today we're going to be talking about Warren Buffett strategies for beginners. These are going to be strategies Warren Buffett uses just to make your first initial investment. I'm going to come up with 7 questions on how to make an investment, what to look for so you can make the proper investment when you're looking at a company. Before we get into this video, can you please like it? Can you please subscribe to my channel? I'm going to be providing a lot of good content and it's going to help my channel out a lot. Thank you. The first question Warren Buffett asks himself is, do you understand the business? Are you capable of understanding the business? Do you understand how the product works? And this is a key question to ask yourselves because if you do not understand the business, then you're just going to fail. You're going to just make assumptions about what's going to happen in the future. And this is not what we want to do when we're investing in stocks into companies. We got to know how the product works, not down to like the exact science, but at least know how the product makes money in the market. So when we think about this, think about a company probably like Nike. We can understand Nike. It sells shoes. It makes new products. It sells clothes. It sells shoes. It comes up with new designs. It's a very simple business, and people want these shoes. People desire these shoes. So when you think about this, you have to understand that if you do not understand the business, you won't know if the company or the product is going to become obsolete in the future. So that's why we need to understand the business and understand how it makes money, because what if there's a problem with the business? What if something happens to the company? And if you don't know anything about the company or how the product works, you're not going to make the good decisions about what should I do with this business? Should I keep it? Is there something outside that I don't know that's going to take over this company? That's what we got to find out. That's what we got to know. So understand how the product works, how it makes its money. It's very valuable, and this is going to help your investment practice. We do not want to invest in companies that we have no idea how do they make money. We got to keep it very simple. The second question Warren Buffett asks himself is, does this company have a competitive, durable advantage? We have to figure this out, guys. If we're not figuring out if the company has a competitive, durable advantage, we'll have to move on to the next company if we can't figure this out. And you have to be able to talk to if you had a younger sister or younger brother, you have to be able to explain it to them. Keep it very simple. If you can't explain it in a couple of sentences what the competitive advantage is of that company, then move on. Find the next company. We are not trying to invest in price competitive businesses like cars. A lot of cars don't have a competitive advantage. You can buy this car, that car, this car. It doesn't really matter, except for the few cars like Ferrari or Porsche, because they have a strong brand name. So going back to my example of Nike, we can just lay it out in a very simple Nike's brand name. People buy Nike just for the name, for the product. You just put Nike on a sneaker and people will go and buy it. It has a legacy too. The legacy of Nike is very strong, like the Jordan brand, like the Nikes, like all of that combines into a strong brand name and product. So when you think about that, that's all you gotta say. It's a very simple answer to a very simple question. What is the competitive advantage of Nike? And it's its brand name. So when you think about that, you have to be able to just answer that question. And when you answer that question, it has to be very simple. Make sure you can answer that question in 2 sentences. And then, is that advantage durable? We want to buy companies that are going to last 5, 10, 15 years into the future. So we're not risking our money. If we can't think about the company 5, 10 years into the future, then we don't know how profitable the company is, and we can't trust our projections of the future cash flows of the business. So we have to understand if it's a durable competitive advantage. And is the Nike durable? Yes, it's tested the times. It tested the times. Company's been around for 15, 20 years, and it's still strong in the market. It's still really innovative. The brand name is that strong. People just buy Nikes just for the brand name, for the clout. So understand that Find companies with a competitive advantage that make it very durable. The third question you got to ask yourself, if this company has a durable advantage, will this product be obsolete in the 5, 10, 15 years in the future? Can you predict that? If the question is yes, it's going to be obsolete in the next 5, 10 years, move on, find the next company. If the answer is no, then you can continue on into this process of answering these questions. So guys, we have to understand that the durability of these companies and its competitive advantage is key, because when we're evaluating a company, we're trying to predict the future cash flows and discount that back to today. And we're looking at 10 years. So that durability of that company's competitive advantage, say example Nike's brand, it has to be strong. It has to show lasting effects. What do you think can take over Nike? That's how I think about it. What product can take over Nike? Is shoes gonna be, are people not gonna wear shoes in the future? Like, what's gonna change? Warren Buffett bought Wrigley's gum. Is someone gonna be able to chew gum differently? Is that gonna be gone in 5, 10 years from now? No. So we gotta think about stuff like that. Have that mindset of understanding the product and seeing if it's a durable product, if it's gonna last 10, 15 years in the future, or the company. Number 4, does the company exclusively allocate capital into the companies that it knows, that has the expertise in? When we think about this question, we have to think about companies that actually know what it's doing with the capital that it has, that it retained, because we wanted to actually buy businesses that it really knows. If it's buying businesses, like say Nike is buying businesses in the boating industry, that's not a good use of capital. It doesn't have the expertise in that. Like, we would question the management. Like, what are you doing? Like, you're not using the money, or our money, that because we own the company, effectively. You're not using that money effectively, right? So when we're looking at management and how it's allocating capital, we got to make sure it's buying businesses that have competitive advantages already. So they're using that capital effectively. That's going to keep generating income on our money that we have in the company. We don't want our company to buy price competitive businesses where that business doesn't do a lot of revenue, it doesn't earn a lot of profit. Like, we don't want the management that we own doing that. We don't want them to buy those type of businesses. We want them to buy competitive advantage businesses. And we got to make sure it's in the realm of what we're doing. They're saying a boating industry buys another boating company. That's what we want. We want to see how management uses that capital and buys another company that has a competitive advantage too. So when you're looking at management, look for those signs. Is it buying companies that has no idea what it's doing? It's not in the realm of its main company? Think about that type of stuff and see what is happening in that company that you're invested in. 5th question, what's the earnings per share history, and what is that growth rate on the earnings per share? So when we look at this question, we got to make sure that earnings per share has a consistent trajectory. We don't want that erratic behavior. Maybe it's 151, and then it's 130, and then it goes to 170, and then it goes back down to 51.51. Like, we don't want that when we see earnings per share. We want that consistent rise of the earnings per share year after year. And then we want that to be growing at least 12% a year. Like, minimum. Like, we want to see a good earnings per share. And when we find those erratic earnings per share, we just move on, find the next company. Look for another company that's going to present us a good buy or a good bet on our money that we're going to use. When we find these companies, we got to make sure that the earnings per share is consistent. And if it has 1 year or 2 years where it's kind of bad, we look into that, because maybe it's going to be providing us an opportunity to buy that company. If it's a short-term problem and it's going to be taking care of itself maybe 1 year, 2 years down the road, then that could probably provide an opportunity to buy. So we look into that. If it's not fixable, then we just move on to the next company. Remember, there's so many companies in the market. You don't have to be so persuaded by this one company. If you find a fault in it, if there's something that we don't like, if it's too hard to understand, we just move on to the next company. 6th question, Does this company have a consistently high return on equity? We're looking for 15% or better. And this is a very important metric. We want companies that actually generate money on our shareholder equity of what we own. Because we got to think of these businesses like it's ours, that we own it, because we do own it. We own shares of the company. So the profit that it's making on our equity is going to be very important. And that's what's going to make us rich. We want to find companies that are just going to keep generating a lot of money on our shareholder equity, increasing the earnings per share year after year after year. And then when the market sees this, it's going to put a higher valuation on that because it's earning so much money on the shares that we own. So finding companies with 15% or better on return on equity is key. And if we don't, again, move on. Find a new company, find something that's better. We want that good return on equity when we're looking at these companies. Lastly, we want to find companies with high return on capital, 15% or better again. And this is the same reasoning for the high return on equity. ROC is just kind of putting in the debt of the company with its shareholder equity and seeing how much the business is returning on that. And that's just like a key metric to see how efficient, again, management's using our money, the money that it retains, because we got to think about it like we own the company when we're buying these companies, and how much is it earning on that, including debt in it, because we don't want these companies to be just using debt ineffectively. They're just wasting money. They're buying stuff that it's not effective. So we got to look at the ROC. Is it earning a high return on capital, and how effectively it's using that cash? So that's what we're going to look for, 15% or better. And that's it for the video. Guys, if you like this video, can you please like it, subscribe to my channel, and I'll get back to you in the next video. Peace.